Okay. Hi, Assalamualaikum, and I'm Nurul Ain, along with Muhammad Afif, Heng Himi, Nur Izzah Syairah, and Nurin Saiful. We are from Group 2. Today, we want to cover the title of tax structure. Well, let's move on the introduction of the tax structure first. Okay. Introduction. A tax is a compulsory charge or some other type of levy imposed on taxpayer by a governmental organization to fund government spending and various public expenditure. Tax objective is taxes are source of government revenues and influence for the economic growth as income distribution tools to decrease the gap of the poor and the rich.
Okay, tax structure. The tax structure are divided into two types, normally direct tax and indirect tax. Direct tax are the tax imposed directly on taxpayers. The tax burden cannot be transferred to any parties, for example, individual income tax, corporate tax, and profit tax. Indirect tax are the tax imposed on service and goods. The tax burden can be transferred to any parties, for example, service tax, customers duty, and sales tax.
Types of income tax payments. Regressive tax is a tax imposed in such a manner that the tax rate decreases as the amount subject to taxation increases. Proportional tax is a tax imposed so that the tax rate is fixed with no change as the taxable base amount increases or decreases. Progressive tax is a tax in which the tax rate increases as the taxable amount increases.
How to determine the structure of the tax? To determine the structure of the tax, we must compare between the original and the new income and taxes. For the formula is tax must be divided by income and must be multiplied by 100%. So for example, original income is 12,000 ringgit and the original taxes are 1,320 ringgit. So if we divide 1,320 with 12,000 and multiply it by 100%, it will be 11%. That is the tax rates. To calculate the new income and new taxes, we must use the same formula. So 2,340 divided by 18,000 multiplied by 100% will be 13%. If we compare 11% and 13%, there is an increase. So it is called progressive tax. Budget and the types of budget. So the budget is a government financial plan in a year. There are three types of budget, which is deficit budget, surplus budget, and balanced budget. Deficit budget is when the government's expenditure is greater than government's revenue. Surplus budget is when the government's expenditure is less than the government's revenue. And balanced budget, when the government's expenditure are equally balanced with government's revenue.
Okay, the last thing that we want to discuss is methods of financing deficit budget. There is 5 methods of financing deficit budget, which is domestic loans, foreign loans, special receipts, changes in government's property, and tax revenue and non-tax revenue. For domestic loans, selling treasury bonds to the public such as business bank or other financial institutions such as BSN and EPF. For foreign loans, they are selling treasury bonds in international markets such as London, Tokyo, or USA. For special receipts, it is known as International Monetary Fund or IMF or World Bank, but this contribution is very small. The fourth is changes in government's property, ways of selling property such as government's building, land of government investment. And the last thing is tax revenue and non-tax revenue. The government can increase tax revenue such as imports, service, and other than that, and non-tax revenue like road tax, royalty, and others to increase government revenue. That's all for today. Thank you.
Thank you for watching.